Hey guys, so today I want to show you a quick, very simple way in which you can measure the market's overbought or oversold reading, and we're just about to head into a fresh 5-session trading set here. So let me go and quickly show you. We added a brand new feature in Market Rover 2.0, which we're about to come to market with. So I want to quickly show you this. Let's flip the camera and have a look at this feature and how you can use this as well. So the feature is very simple. What we're looking at, it's this one here. You want to focus on all the way up here, this one here. Number of stocks in the S&P 500 above the 200-day moving average. And right now you can see that's close to almost 70%. Meanwhile, and this is really important, the VIX is at the very lower end of its range, right? We added a lot of other stuff here too. We can talk about that in a future video. But it's the combination of this and this, so low VIX and that. And so I'm not into sort of doom and gloom kind of talk, but I want to at least give you a bit of an idea of what that means. So we're seeing a lot more stocks, pushing higher. Meanwhile, the VIX, which I think is interesting to follow, is once again below 13 with last week's rally, and you can see we are at this red horizontal line again. This is a year and a half, a year and 3 quarters of VIX data, and you can see when we get to the lower end of that range, it doesn't mean we have to blast higher right away in terms of volatility, but certainly the odds of remaining down here, or the odds of further decline, I should say, in volatility, are basically non-existent. So this is a simple way to measure risk. In my personal opinion, I think here at this point, even though I'm not calling for stock market crashes or market depressions, this is really more a call of looking at stocks that are pushing above the 200-day moving average, above their respective 200-day moving average, I guess is the better way of putting it, and combining that with something else. Because like I always talk about in these videos, it's not about looking at one data set, it's about looking at a couple data sets at least, usually hopefully 4 or 5 different data sets, and seeing how they interact and what the relationship is. And the relationship between stocks going above the 60 to 70% percentile of stocks above the 200-day moving average, combined with the very low VIX, statistically speaking, doesn't bode well for stocks in the near term going forward. Doesn't mean there has to be a massive crash, but it usually tends to lead to a bit of a spike. So just wanted to give you that little bit of a nugget of information. I hope it's helpful, and I wish you a good start to the week.